Welcome back to the Everything Property Podcast. We've heard your feedback, and what you've wanted is the investor stories, how everyday people have built everyday portfolios. So I thought I'd start today off with a bang. Today's guest has grown an 81 strong property portfolio worth at last calculation a whopping $68 million and generates $55,000 per week in rent. Not only that, but as of last calendar year, he ranked inside the top 25 residential brokers across Australia, awarded by Mortgage Professionals Australia, or MPA. Here to tell us the secrets, the story, and how he's done it is Michael Shah. Michael, welcome to the Everything Property Podcast.
Thank you for having me, David.
That's all right. Thanks for coming on. Well, look, it's obviously you didn't start at 80, 81, so I want to probably dig in and touch on those early days in property, investing. How'd you start your journey? No doubt now you've got a refined system with how you do things, like we were talking about before we jumped on. But back in those days, the early mistakes, the early purchases, what held you back, what propelled you forward?
I think with a lot of people, you kind of fall into it. My first one, just like a lot of people that don't know much about property investing, I bought off the plan. This 39 square meter studio in Epping.
Congratulations on making the worst possible first purchase, yeah.
So I was pretty much at uni, walked in and asked for the cheapest unit to get into that complex. And the reason why I wanted to get into that complex was because of the gym, the sauna, the pool. I just got sold all the shiny, bright things. And I'm like, man, this will be a cool bachelor pad.
Yeah. And then the first quarter of strata fees hit you. And you think, oh, this is a bit different.
So to put it into context, This is 2004, 2005. It was studio in Epping. And off the plan, I paid $340 for it back then. So this is almost 21 years ago, $340. At that same time, for $340, I could have bought a house in Blacktown. Easy.
And does that still make up part of the portfolio?
It does still make up part of the portfolio.
What's it worth now?
I think I'll be lucky to clear 500 from it. Over 20 years. So when they say property prices double over 7 to 10 years, definitely not all properties.
Yeah, it depends what the asset is and what you're buying. Definitely.
Yeah.
Okay. And then that was PPR though.
No. I did buy it as my PPR. Moved in there 6 months. And then after that, moved back home because I had no money in the bank account.
What were you studying at uni at the time?
Just doing commerce.
Okay.
Yeah.
Commerce.
But it was a 3-year degree for commerce. And it took me 8 years to finish that because I never just turned up to uni.
Wow.
So that was the first purchase. The second one was right around the corner in Macquarie Park. That one, luckily, I did a little bit better. Bought this 2-bedroom red brick unit on Herring Road, just down the street from Macquarie University.
Okay.
Bought it for around $400,000 and now it's worth about $800,000.
Okay, but what is the time difference between the two, and how do you get from 1 to 2 at that early stage? Because if you're a uni student, you're not earning too much.
Yeah, no. So the first one was off the plan, so bought it and then settled a couple of years later. And then between that, it was a good 5 or so years before I picked up the next one. So in that time, didn't really know what I was doing, was just saving. So I was working. Part of the reason why I didn't go to uni was because I was also working full time. So I had the money saved up and then ended up just buying that 2-bedroom unit in Macquarie. And the only reason I purchased it was because my friend lived in that complex.
What were your aspirations in terms of what you wanted to do for like a career moving out?
So I was in market research. So my job was, when you surf the web and then you get those online ads that pop up? My job was to put those ads on the browser. So, and this was, so kind of when the penny dropped was when I was about 28. So this was in like 2013.
Yep.
And at that time I had 2 properties. My corporate job wasn't really going anywhere. And I was just like, man, there's got to be.
You say this is 2013?
2013, so 12 years ago. So 12 years ago, exactly pretty much now, I was sitting on 2 properties.
Worth, at that time, 500 grand. No, less.
Probably about 400,000 for the studio.
Wow. So in 12 years,
correct,
you've been able to build what we're going to go through today.
Correct, yeah.
That is unbelievable. That, man, honestly, hats off to you. And that is super impressive. And one thing that also makes it more impressive too is before Michael come on today, he sent me a spreadsheet of all his purchases and where they are and what he bought them for. And yeah, seriously impressive. What was the penny drop moment though in 2013 where you were like, something needs to change?
So in high school, I went to one of the better high schools in the States. I went to James Rose.
Oh, okay.
And looking back at that point in my career, all my friends were like doctors, lawyers. They've been doing really well for themselves. And here I am. I'm like in a dead-end job in market research. And at that time, actually, long-term relationship broken up. So I was like basically rock bottom.
Lost.
And I actually remember it was like New Year's Eve. I was with a bunch of mates. We were all drunk on the beach, and I woken up, and it was like New Year's Day, and I'm like, "What the frick am I doing here? Like, I need to do something to change my life. Otherwise, if I keep going down this road, I'm not really going to amount to too much." And at that point in time, I didn't know what I wanted to do. So, whether it's business or some form of investing, but I knew I needed to do something because if I didn't do anything, then it would just be the status quo. And it was just through a series of fortunate events. Meeting my mortgage broker back then. So in 2013, I met my mortgage broker. And I've spoken to so many other brokers before him. And I'd heard of these people building these property portfolios. And I'll have a chat to the broker and he'll be like, well, you can buy another 1 or 2 properties. And I met this guy, he's called Rolf Latham. And I still have this diagram that he drew up for me. He's like, you're on 2, I can take you up to 10 properties. And I'm like, how is that even possible? So I just followed his advice, went down that roadmap, and in 2 years I went from 2 to 14 properties and then quit corporate.
How? Whoa.
Yeah.
2 to 14
2
in
to
2
14,
years.
yeah.
How do you do that?
So right in the beginning, we pulled out the equity from Epping and also Macquarie Park. And at that time, the Sydney market was starting to turn a little bit. So I pulled out the equity, had a little bit of savings, actually borrowed 100K from my parents. And with that little bit of a nest egg, I went off and bought 3 renovators. So one was 155,000 in Nambucca Heads.
Okay.
Yep.
Yeah.
195 in Gateshead, which is in Newcastle, and another 3-bedroom renovator in Cardiff in Newcastle for 225. And I just dropped all the money that I had into the renovations, and then post the renovations, 3-4 months later, got them revalued and managed to pull out the equity.
So did you learn renovating? Were you handy on the tools?
No.
Is it you getting the trades in?
I can't even change a light bulb. Like I just sit at the computer the whole day.
Okay. And
So-
you're getting trades in?
Correct, yeah. So all I did was I would go up to Nambucca Heads, I'll go up to Newcastle. And so it all actually started with Nambucca Heads and I met this builder. So it's actually a great story. So found a bunch of builders to go on site to then quote in terms of the job. And the builder that I ended up picking, he was in his 70s and I asked him, why are you still building today? And he goes, my mates that have stopped working, they've all dropped dead. So I knew at that point in time, money wasn't his main motivation. And he just kind of took the project under the wing. He didn't charge me the renovation cost for a whole year because he was like, look, I made enough money this year. I'm going to push it out to next year. So he did the renovation for me in Nambucca Heads. And then he drove to Newcastle and did the other 2 for me.
Wow.
Just unreal. Like, this guy's unreal. Yeah.
Talk about
His name's Gary O'Brien, and he used to be, like, back ages ago when he was young, he used to be Mr. Australia.
Jesus. Gary O'Brien.
Yeah. From Nambucca Heads. So, yeah. And that was back more than 10 years ago. I still think his, business is up and running now. So he will be in his 80s and still building.
Around. Well, I think it's also important to note that lending.
Completely different.
Yeah.
Yeah. I mean, back then there wasn't APRA. My salary was around 85,000, and when I quit corporate, my total loan size was a little bit over 3 million.
Wow.
So, I mean, yes, it was a lot easier back then. It is still possible to do a certain scale to that same extent. Like I've still got clients at the moment. I've got one guy, young guy living at home. His salary is just under 90,000 and he'll be up to his 7th property and loan size just a touch under 3 million.
Wow.
Yeah.
Have to get him on, mate.
Yeah, no, definitely. Yeah.
Dob him in, get him on.
Yeah, 100%.
Chat about that. in terms of selecting those locations, was it a price thing? Was it a data thing back then? Because you don't have all the tools available that you do today.
No.
So how'd you come up with those different locations?
So in 2013, I remember going out to auctions out in Western Sydney. And even in 2013, I paid for the building and pest for some renovators in Mount Druitt.
Oh.
And they ended up selling for about $230 to $240 back then, which sounds crazy, but that was actually possible 12 years ago in Mount Druitt. And I remember not bidding because a couple of months earlier, a similar one sold for $220, $210. And I'm like, man, this is too much. It's gone up.
little did you know. Huh?
I know. But back then, what also made me realize, I thought, hey, look, Sydney's starting to move a little bit. And I used to be an absolute addict to Summersoft. You remember Summersoft?
Mm-hmm.
Yeah, which now is Property Chat.
Summers, yeah.
Yeah. And before that, when I looked at all the posts from like 5 to 10 years earlier, a lot of people on that forum were saying when Sydney moves, the satellite cities then start to move afterwards. So in my head, Sydney was already moving, then why don't I look in Newcastle and also Wollongong? So one weekend I'll be in Newcastle, the other weekend I'll be in Wollongong. And it just so happened that I got lucky that I ended up picking those purchases in Gateshead and also Cardiff.
Okay, and then it was the 3-month reno. You got the guys in there. Reval,
strip out the equity. And then at that time, the whole process would have taken about 6 to 9 months, just, in terms of the buying, getting the property renovated, rent it out, get the revaluation, get the loan approved. And when I wanted to then buy back into those markets, they had started to move. And this is edging in around about 2014, 2015 period. And I'm like, look, I can't buy for the same price because at that point in time, you couldn't buy in the 2s in Newcastle anymore. And I'm like, where else can you buy? And from 2015 onwards, pretty much for 5 to 6 years straight, I just only bought in Brisbane and just in one council in Logan.
Yeah.
And like you'll probably see from the spreadsheet, it's just pretty much every suburb in Logan Council.
And respect to you because, you would have had a really good ride through, COVID and after that because that Southeast pocket just absolutely blew up, right?
Yeah, everything is easy in hindsight, but I still remember my wife around about 2021 going, Michael, don't you have enough there? Why do you keep buying? They haven't increased in the last 5 years.
Yeah.
Isn't it time to buy somewhere else or stop doing it? But in my head, it just made sense. I'm like, where can you buy for around 300,000, 20 kilometers to a CBD, renting at 6-7% rental return, and on top of that, the prices hadn't moved for almost 10 years. So in my mind, it was just due.
That was it. That was the decision making.
Correct.
Wow. Okay, so you go into the Brisbane market. Is the same play buying stuff that you can renovate, or how are you servicing these purchases and all that at the moment?
Sure. So part of the reason why I had to buy in Logan was because my borrowing capacity wasn't as good. So I had to buy stuff around 300,000, renting at $400 per week. Mm-hmm. And then after that, in terms of servicing, then I just used banks that were easier and easier and easier to borrow from. And even back then, in terms of there were tiers of lending, but without APRA, you could actually go a fair bit in terms of the tiers of lending back then.
Yeah, you could. It was a lot less strict and a lot less policy than it is today.
Yeah.
How long you stay in Queensland for, and what's the next move after that?
So after that, that would then so from 2013 to 2015 was when I was building the property portfolio through my corporate income. And 2015 in May, when my 14th property settled, I handed in my resignation to the market research job.
Talk to me about that day.
You dream about it so much leading up to that day. It's almost anti-climate. It's just another day. But in my mind, it was so on the Friday was the last day. And then on the Monday, I packed all my belongings into this small Mazda 121 car and drove all the way up to the Gold Coast and then worked from Rolf's office for the next 2 years.
Wow.
So my mortgage broker that mentored me, I was like, can you teach me what you did for me? Relocated to his office and just worked from his office for 2 years to learn the trade. So he gave you
sort of a job?
So it wasn't a job. I was building my business, but I was just sitting in his office so I could learn from osmosis.
Wow. And what made it? Why did he pick you? Why was he happy to do that with you?
So it wasn't just me. He's mentored so many other brokers. Like he's kind of like a godfather of broking. There's many other, there's the property twins that you might have come across in the property space. There's myself, also another guy. So me and Stephen Ryan, who was another broker back then, we quit at the same time. We went up to the Gold Coast, lived at the same Airbnb house, and worked from the same office, all building our broking business.
Jesus. So that's when you started broking as well?
Correct. So that was in 2015.
2015. So you've had 10 years at that now.
Yeah.
And then, is it a bit of a slowdown because of income and getting that rolling, or after sort of 2015 and onwards, you've got those Brisbane purchases, so they're starting to grow, or maybe not grow yet, but you've made those purchases?
Yeah, so what happened from 2015 to 2017 was like a hard period because didn't have 2 years of ABN registration, couldn't borrow. And I just saw all of my clients picking up these great deals and just sitting on the sideline, just itching at the bits. Yeah. But all I knew was for those 2 years to grind as hard as I could. So once I had the 2 years ABN registration, had the tax returns, then could go again. And I remember completing my tax return, we refied every single loan. So moved it from the lowest tier of lenders. I moved them all up to CBA and stripped out $1 million worth of equity.
Oh, dear.
And then I just went shopping with that. Yeah, so with that, I just doubled down in Logan again.
So still.
So that was around 2015. So from 2015 to 2020, 2021, it was all just continuously Logan.
Really?
Because that like at that time, prices still hadn't moved.
Yeah, so, I know, but it's crazy that you still went in that one market.
Correct. Yeah.
Are you buying these personal name? Are you changing up structure, or?
Some of it was through trusts. Majority of it was in my personal name.
Wow.
Yeah, but I did buy, especially the larger ones. So we have about 4 blocks there, and 3 of them are edging on 4,000 square meters. So you'll see in that spreadsheet one, which is Kingston.
Yep.
So we bought it like 2015. It was 4,000 square meters in Kingston, and we picked it up for $750.
In when?
In 2015.
Wow.
$750 for 4,000 square meters. And now that we're just now in
I'll buy it off you for $750. Yeah.
So we've completed the subdivision, finally got DA approval. We're now moving into the build phase. Each of them's so we split it into 7 separate blocks, house and granny flat on each of them.
And you're going to keep?
Just keep and rent out.
Oh my God. And so you get what was that block worth probably in today's dollars?
A little bit more than double. Yeah, about 1.5, 1.6. If I did it now, bought the block and tried to do that project, the numbers wouldn't make sense.
Yeah, but
it's only making sense because I picked it up like 10 years ago.
Wow. And it's basically just keep buying in there because you feel that it's undervalued, and it's only a matter of time before it pops, right?
Correct. I mean, don't get me wrong. There was times I even doubted it. I'm like, everyone's been saying this year's going to be the year of Brisbane. For 5 years, it was not the year of Brisbane.
And you're waiting.
Correct.
Oh my gosh, you said it was this year.
Yeah. And then as I'm waiting, these deals kept popping up. I'm like, the numbers seem good on this. Even in 2021, we bought at auction just a normal high set on 600 square meters for like $240 in 2021. So even up until that point, the numbers were just amazing. But then after that, overnight, the prices
2022 and onwards,
just gone.
That's probably now 600.
Correct.
650.
Yeah. So around that time, around 2021, still wanted to buy a few more, but it was getting very, very hard, and then moved towards Perth at that point in time. And that was fairly early on in Perth. And the reason why I started buying in Perth was actually a client of mine.
Yeah.
And this is like a great story. So they're a migrant family. They come over to Australia with nothing. They both work in hospitality, saved up enough, and then bought their first owner-occupier. I think they paid for like $250,000 for a 4-bed. This is in 2020 in Perth. And this is around the Mandurah area. And you'll see that my properties all around the Mandurah area. And we did the loan, and then within like 6 or so months, poured out a little bit of equity, bought this next one. And as I'm seeing them buy these properties, I'm like, how are they so cheap? And the rental return is so good. It was like 7-8% rental return. And this is around 2020, 2021.
You got Perth early, man.
I know.
People piling into Perth.
I know. And by the time he bought his second one, I'm like, hey, can you tell me a little bit more about this area? I've never heard about it. So walk me through going, hey, look, it's kind of like the central coast of Perth. 45 minutes south of Perth. A little bit rougher, but in these areas, avoid these pockets. These pockets are good. And listen to his advice. And in 2021, bought 3 properties there.
Well, you're buying in the central coast of Brisbane, like that Logan pocket, right?
Well, that's a Mount Jordan. Yeah. It's kind of a reflection of same in Perth. Yeah.
It didn't scare you.
No.
Okay, is your thinking there like the undervalued, the cheapest stuff you can get your hands on?
So one thing that I've formulated over time is if you want to make money, just do the opposite of the general crowd. So if the general public is buying, then look to sell. If the general public is selling, then look to buy. It's kind of like Warren Buffett's be fearful when other people are greedy, be greedy when other people are fearful. So in 2015, you talk about Logan to people and they'll just laugh at you. I'll be like, why? That area never goes up. It's like
Who's laughing now?
But that was the same in Perth. Like I remember there was one property I bought in Perth in 2021 in Coodanup, 1,000 square meters, 3 streets back from the water. I paid $276 for it for 1,000 square meters, 3-bedroom house. And the previous owner in 2007, so 14 years earlier, bought it for $385.
Wow.
So when I bought that, have to put it into context, I show my friends and family and they thought I was off my rock. They were like, 14 years, this guy's lost 100,000. What makes you think you're going to make any money?
True. And that's the thinking that a lot of people would have.
Correct. And they were like, look, Perth is a mining town. It would never go up. But when more and more people said that, that also gave me that confidence because I've seen it with Brisbane is when other people say, no, don't go. That's not going to make you money. Then that makes me look into that area a little bit more. But when everyone's piling in going, hey, look, you're going to get double-digit growth for sure in this area, then I start to get a little bit wary and then move to the next.
What's your philosophy in terms of like numbers or end goal at this stage? Are you thinking about like a passive income target or it's just keep going and buying and buying and buying? Because it's starting to rack up. You're probably in teens or 20s in terms of property.
Yeah.
Like number, like what's your partner saying at the time? Like
I would say the strongest motivator in all my journey was for that first period where I just wanted enough recurring income to quit work because I hated corporate so much.
Yeah.
And I think when you have a really strong burning goal, then that's kind of what propels you there. So I'll say when I hit 14 properties and quit corporate, after that, it was more so just kind of almost arbitrary numbers you put in front of yourself to kind of drive you a little bit further. But that's not like I had this goal was like 36 properties by 36.
Yeah, okay.
But do I like go to sleep kind of really wanting to push for it? It wasn't so much.
What was the income when you quit your job and you have 14 properties under your belt back in those days?
It's about 85,000.
85 grand.
Yeah.
Positive?
Oh, as in positive income?
Yeah, like what do you...
No, so that was my corporate income.
Okay.
My corporate income, I would say recurring, probably only about 40, 50. It wasn't much.
Okay.
Yeah.
But you just thought that's enough to pay the bills and get me by.
And then also the other opportunity of becoming a broker and then building that up was just so much more of an upside. And I just didn't want to be where I was at work.
So you're building as well that broker up front, that broker trail to fund everything else, right? You're having your own business. The lending's a little bit, once you've passed those first couple of years, I'm imagining the lending's getting a lot easier.
100%.
You're helping out clients. And like one of the things I said the other day, I think it was to Travel, someone I was talking, I was like, being a mortgage broker, the cool part about it is you can see where everyone else is buying, right? And
that was like in Perth. I saw where the client was buying and the numbers were amazing. If he didn't buy, I would never in my mind look in Mandra. Like,
how are you going to pull that out?
Yeah.
What made you jump out of the Perth market?
Perth market, well, I mean, it had doubled, from 2001 to 2024. That same property that we bought, I mean, my first one was a 422 there and we picked it up for 311 and now it'll be closer to 680, 690. So at that point in time, over 3 years, I don't think anything goes up forever and I don't think anything is bad forever. So I think, even if I buy today, no one can pick the top or no one can pick the bottom. Like I don't believe anyone can. I don't think I'm smart enough can. But I feel if I enter the market now in 2024 and I buy that property now for say 680 and I hold it for another 2 to 3 years, I don't think it'll go to 1.2 or 1.3.
Definitely not.
I would rather go in another market that hasn't been good for the last 5-7 years. And then hopefully then I don't need to wait as long then to have that doubling effect.
How did you navigate COVID with all this happening, right? Because you've got all these properties under your belt, and the media, God forbid, is telling everyone, property prices are gonna go down 30-40%.
Yeah.
How did you sort of navigate that time?
I don't think that's really so it's more so through past experiences. So in that fact, then when everyone else is scared, that's the best time in terms of opportunities. And I just reflect back on the times when things looked like they were going to hit the fan, the world was like going to end tomorrow. And if you look back on each of those time periods, that was the best time to be making moves. And the one that really stuck in my head was during the GFC. So this was when I was at uni, no money, but I could just see all these opportunities.
How painful is that? All right.
And I just remember just, making a mental note to myself, if something like this happens again, hopefully then I can make something happen. And during COVID, that was an opportunity.
So you went harder in COVID?
So during COVID, I didn't slow down. So I bought those properties in Perth during COVID. I've never been to Perth, still haven't been to Perth. Mm-hmm. And even in Perth, if you wanted to buy there, you couldn't because it was locked down.
True.
So all those properties, I just did FaceTime with the agents.
You trusted the agents FaceTime?
Yeah, we just did FaceTime. They had plenty of time on their hands, because no one was buying, so they would happily walk you through. And I find with the FaceTime, because one-on-one, they would showing you everything, it was no different to then going there in person. Yeah,
but sometimes the agents, when they do the walkthrough, they'll stand with their back up against the hole in the wall, and then they'll be like, yeah, see, it's all good, yeah, nothing to see here. Oh, let me flip the camera, I'm out of the room. Nothing like that, no dodgy.
I mean, I'm sure they might have done it, I just didn't notice it, so yeah.
Well, you haven't been there,
correct, yeah.
And then what, do you sort of know what number or what sort of stage you're up to, and is there another... you would have just been unlocking so much value in Southeast Queensland, in Perth, right? So you would have just had so much equity. Is your business providing the serviceability by this stage?
100%. So it's one thing that I also say to my clients, they're like, oh, how are these people on 20, 30, 40 properties? You can try to extend the lending to a certain point by using banks that are a little bit easier to borrow from, potentially using trust, but ultimately it's a function of income. If you're going to borrow more money from the banks, you're going to then have to be able to repay that mortgage in some way, shape or form. So ever since 2015 up until now, everything's pretty much off the business income.
Wow. And what was your next sort of pocket after Perth?
After Perth?
Yeah, early 2020s.
Yeah, so from 2020 up until 2023, 2024-ish was a period I just didn't really know what to do. And we were in the process of taking out the equity, having it sit there. And for a long period of time, I just remember chatting with my missus. We'd be like, oh, okay, let's go into commercial, explore commercial for a little bit. And then we're like, no, let's go and buy a PPOR. We've sacrificed enough, let's buy a PPOR. And then the next one, oh, why don't we do some flips in Sydney? Buy a renovator, do it up. And it was just a complete cycle of just going around in circles. Yeah. And then ultimately around 2023, we landed up buying unit blocks in Sydney.
Okay. So in those Perth markets and those ones there, are you still renovating by that time? Or you're just, because you're buying so cheaply and you're purely making your decision based on yield and it hasn't popped in a long time, it's due for it, right?
Correct. And that was similar to what I was doing in Brisbane too. I could have done renovations there, but the time and effort and the fact that I was located in Sydney and buying in Brisbane was just going to be a little bit harder. And at the time, the numbers made so much sense that I didn't need to do renovations to make it work. I could buy a house that was already okay for $280, $290, or buy a renovator for $240. You might have made a little bit $1 into $2 in terms of the renovation, but the gap wasn't so big there.
Yeah, okay. And what were those ones at $280, $290 selling renting for then?
$400.
$400.
Yeah.
Okay. And so the strategy then moves to unit blocks, and is that because of the income available? You obviously, some of those ones we talk about, your most recent purchase around the corner, you're starting to get into really expensive assets now, unit blocks as well. Is that because you've got all this money from the portfolio and the business to go up play? Because, you could have just kept on buying those very cheap $300,000-$400,000 properties, but why to unit blocks, I suppose?
Sure, that's a good question. So one of the things around it was, in terms of buying the unit blocks, the harder entry point was a deposit. So we're looking at about 35% deposit, 5% for the stamp duty. So it'll be 40% upfront. And the way that we managed to make that work was all the equity that we took out from the Perth and also the Queensland properties. So it's these crappy Logan properties that planted the seeds for these unit blocks in Sydney.
All right. And do you have any, can we run through a few of the examples of like, the prices, what you've purchased, what you've done, just on a couple of those?
Yeah, sure.
Like, we can run through like purchase prices, and I've got it all up here, but like, yeah, just a couple for example, so people know how you've then catapulted into, because sometimes these are 8, 9, 10 in a row, right?
Yep.
Because I see here there's a couple of blocks. There's probably, you've got blocks of 6, 7, 9,
and 12.
Yeah, there you go. So what's the first unit block play? What's the strategy, and how do you find a unit block that's worth buying and renovating and or flipping?
So it all started with the first one, which was Belmore. And up until that point in time, we've been looking around for like commercial / larger projects to do. Because in terms of scale, if we keep buying these ones that are like 500, 600,000, a lot of time and effort goes into that. So if we can buy a bigger asset base and can grow a little bit faster. But the key reason is at that point in time, around 2023, 2024, and kind of similar to that reason with Perth and also Brisbane, units in Sydney were on the nose. I mean, even to this day right now, units in Sydney are on the nose.
It's true.
If you look at it comparatively, Sydney house prices have done pretty well over the last 5, 6, 7 years. They've done fairly okay. But if you look at unit prices, go back 5, 6 years ago, it's pretty much the same price it is today. So it's impossible for an area, say for instance, the house prices to go from 2, 3, 4 million, but the units to stay at 500,000, 600,000. There'll have to come a point in time where the gap is so big that the units will play catch up. And then the same thing happened in Logan. Like, you can look at it from a retrospect. I remember early on people going, townhouses never go up, units in Logan never go up. But units and townhouses in Logan now are like 400,000. And then a couple of years ago, you could pick them up for 150, 180.
Yeah, it's ridiculous.
Yeah. So a lot of it is just catch up in terms of affordability. And also, I know before the podcast, we were talking about build costs.
Yeah.
A lot of the things that you're buying, particularly units today in Sydney, they're below replacement cost.
Yeah, if it's a red brick or if it's built well, definitely.
Correct.
And some of those more affordable suburbs, like we were saying, it's just hard for developers to get out and buy. The sites don't stack. You got 6%, 8%, 9% interest rates. If per box prices are, 4, 5, 600 grand, then if you're picking up a pack where the units are 400 grand each, then it's like, well, doesn't make sense. Can't 100%. Replace it at that price.
No,
so
definitely.
So you landed on Belmore?
Yeah, so Belmore. So I'll run through the numbers and you can kind of see that reflected in it. So we paid a little bit over 2.4 for a block of 6.
Mm-hmm.
So each of them was about 400,000, and it needed a reno. So we bought it as a bank mortgagee, and the builder, the previous owner, bought it to renovate it and flip, and then halfway through that, they went bankrupt.
Spewing.
Yeah, and we actually did a bit of research around it, and I think he was actually running some kind of Ponzi scheme.
Oh,
where
yeah?
He was getting money from earlier projects to then pay for later projects and getting more investors on board. But because of the interest rates, eventually it kind of just caught up.
Oh, God. Yeah, okay.
Yeah.
So his loss is your gain.
So we picked it up as a bank mortgagee, and then we did a reno on it. So the reno across the 6 units ended up being about 150,000. And the reason why it was quite cheap was a lot of it was already half done. Mm-hmm. So, the kitchen carcass was already there. Our side of the property had been already rendered. It was just a few touch-ups here and there. So we then ended up doing that.
Yeah, 25 grand a unit, I think we...
Correct, yeah.
Yeah, 25 grand a unit. So you got enough for paint, maybe some fixtures and finishes and the kitchen, really.
Correct, yeah. Mm-hmm. And then also to that, it's actually the missus that project manages a lot of it.
Wow. Yeah, shout out. Okay.
So if it wasn't for her, there'll be no way that could do
She's
it.
committed to the cause and she's getting her hands dirty.
Yeah, 100%. She's just into it as I am. So yeah.
Wow. That's hard to find.
No, definitely got lucky with the missus there. So she'll project manager and she also runs her own property management company. So after we do the renovation, she'll be the one doing the open homes, doing the leasing. So pretty much then try to control as much of that supply chain as you can.
Okay. And then what were they worth after? So 400 grand each.
So 400, so let's call it 425. Mm-hmm. And then after the renovation, the banks revalued it within 3 months at 3.75. So which is a little bit over
600 per unit.
Yeah.
Wow. Great numbers. And because you're not selling, you're not forfeiting any sort of tax or anything like
correct. That. And they were rented at $625 per week.
Wow.
Yeah.
That's
$625 off 425,000 purchase price.
Did you calculate that from the start, or market help you a bit there, or what?
Well, it was the first one, so we didn't really know what we were getting into. And I mean, it probably turned out a little bit better than expected even, but we did project some of these numbers. I mean, they were fairly similar in terms of if you looked at the comparables, but we did actually anticipate spending a little bit more than 150 on the renovation going into it.
All right. So that's a massive equity uplift. We can strip that out and go again. We're obviously assuming that because the broking business, essentially, once you've got that sort of trail starting to come in and you build and build and build, that's just basically like, how have you built that over the years whilst doing that? What's the key to being top 25 in Australia?
Similar to, I think, what we talked about in terms of with podcast, at the end of the day, just consistency. So for 10 years, just every day is like pretty much a grind. Clients will kind of call and go, oh, how's it going? And I'll be like, oh, it's the same, just working every day. So for 10 years, every day is just continuing to build the mortgage broking business.
Wow.
Yeah.
No secret sauce.
No.
And how have you picked up clients? Is it?
So all of it's through word of mouth. I've got no referral partners. So,
wow.
Yeah, all through word of mouth. And then every now and then I'll share my story on a podcast, and that's pretty much it.
Jesus. Well, you go out to all our viewers, that'll blow up. One thing with the mortgage broking stuff I was going to ask, and that list, is that that's commission based, or is that loans written based? That NPA list?
Oh, so that's loan settled.
Loan settled. Do you disclose the number publicly?
Yeah. So last year we settled 187 million.
Jesus.
Yeah, and this year we're going to blow that out of the water.
Okay, so we're climbing up there. There you go, guys. Got in early before you get into that top 10 and you don't want to hear from me. So Belmore, you finish that. You go, hang on, this sort of unit block.
It was like an aha moment. It was like, wow, it's, and I remember kind of seeing these numbers and I just thought this is an even better opportunity than what we realized what Logan was back 5, 6, 7 years ago. And then after doing that project, then pretty much it was just bang, bang, bang. As much as we can, every time we could collect the funds, or if there was a project, we'll then get ourselves into it. There were times even before a project had finished, we bought another one and we didn't know where the money was coming from.
What do you... Oh, man, so
but do you know how sometimes you draw a line in the sand and you're like, this is it?
Yeah.
Then you just make everything work towards it. And that's not to say that like so many sleeps at nights, times it's just like, oh, I don't think we're going to make it, but you kind of pull through those.
Just find a way, right?
Correct. If there's a will, there's a way.
So the strategy now is it purely just unit blocks now, and you think that's better because it's you're deploying more capital. There's probably less of a market there, less competition than, like, let's say if you're going and trying to buy the $400,000-$500,000 range.
I think holistically it's very similar reasons for, say, for instance, buying Newcastle when it first started, then Brisbane, and then also Perth. It's just overall as a market in terms of that asset class, it's undervalued.
Yeah.
So that's kind of like the key context of it. And I think that make that work as much as we can until the point in time where that market will no longer make sense, just like Brisbane, hard to make the numbers work. Mm-hmm. Perth, Newcastle. There'll come a point in time where the units start to experience their growth, and even if you wanted to, they're probably then sitting
Wouldn't
at
stack up.
Yeah, correct. You'll be sitting at 4 or 5% rental return.
What are some of the other? Let's run through a few of the other ones, like 5 Doc, for example. Like there seems to be 5 Doc was looking at purchase price. That was a slightly more expensive investment. Is it similar story there, or what happened?
Yeah, so all of these purchases, they're all kind of like a bit of a unique story in that sense. So 5 Doc, it was at auction. It was a deceased estate. And the funny story behind that is for the unit block, the agent that sold it only put it on Real Commercial, didn't put it on realestate.com. And after investigating, what we ended up happening was the previous owner, she was an orphan and she was very successful. And when she passed away, she had all of these assets and she donated it to New South Wales Health.
Wow.
So the hospital ended up auctioning it. And the agent that handled it was a property manager. So for him, he was just, it didn't, whether it got, 7 million, 8 million, 6 million, it was just going to charity and it was going to sell on auction day no matter what.
Wow.
And during that time.
You found this out after or during the campaign?
After.
Yeah.
After,
okay.
yeah. But we knew it was a desperate, it was a deceased estate. And even the agent that was marketing it, we went for a private inspection. He was half an hour late, could not be asked, just was not like.
Yeah, okay.
We went to the bottom level. And then as we went through the unit, he didn't even tell us when we were going through it that there were water views on level 3. We went up there and he was like, oh, okay, yeah, there is.
You would have played that down though, right?
Yeah, I know.
There's some water glimpse. It's not too good.
But at one point, we didn't know whether he even wanted to sell it or not, or maybe he wanted to downplay it so much because he had his mate that he wanted to sell it to at auction. Like, he just didn't know. But in the end, it just showed up on auction day. At that point in time, it was also just a very bad time to be buying. Interest rates were high. Yeah. There was no...
Early 2020s?
No, this was in 2023, 2024.
Okay.
Yeah. But there was no indication that the rates would drop at any point in time.
Yeah, that was pre the February whistles.
Correct. Yeah. And and it was like one of those commercial auctions in the city. So it was just in a showroom. Mm-hmm. And I remember buying it and then just
like much competition on that?
Not too much. There was 3 bidders. There was 3 active bidders, but no one was kind of going too hard just because of the climate. And I remember coming out of that auction room and just shaking, going, what the hell have we done? Because just in terms of the price point, it was a little bit over 6 mil, kind of going through what you're used to buying your 300,000-400,000 in Logan to that, and just like, what the hell have I gotten myself into? And why it was so nerve-wracking was at that point in time, all the funds we needed to then actually complete that had to come from the Belmore renovation that hadn't finished yet.
Wow.
So we needed Belmore to finish, leased out, get it revalued, pull out the money, then pull into 5 Docs. So we had a 6-month settlement for...
The auction?
Yeah.
Okay. How much in that up front then?
It's 5%. Yeah.
Still,
I mean, 5% is better than, the 35% that you need to pay at the end of it.
Yeah.
But it just meant that you had that time period to make something work. And that whole period was a bit of an unknown. Because what if the renovation didn't go to plan? What if you didn't get the rent?
Wow.
So that was always in the back of our mind.
And you've put worst comes to worst, you can sell a few properties, right?
Correct. I mean, there was, plan B, plan C, and so on and so forth.
Yeah. What are your other exit strategies there?
So sell some shares. I've got some in crypto, but there was actually for another property, we were going to sell crypto, but that was just one point crypto was just flying and then just tanked.
Yeah.
And in that 1 week that we were about to sell it was the week that it tanked. So that was just so many sleepless nights, everything. It just, yeah. I mean, if you ask me would I go through it again, but it did make
bit old, a bit wise.
Yeah.
At the time. Let's get it.
Correct. Sometimes you don't know what you don't know. Yep.
Yeah. What are in terms of entity and structure, did you always have in mind that you're buying and holding these?
Yes.
Buy, hold, retain?
Yes.
So that's a trust purchase?
Correct, yeah, trust. So they're also, the other benefit of the unit blocks is when you say have more than 4 in a complex, they're considered commercial. So you're borrowing commercial for a resi asset. So that comes with its own advantages. So for the commercial, we're just going off lease stock.
Okay.
So a lot of the loans that
Explain for people why that's a big deal and how lease stock sort of can work in your favour there.
Sure. So for lease stock, they only look at the rental return of that asset. Your own servicing doesn't come into it at all. So you could sell your mortgage broking business, be unemployed. As long as you can come up with that deposit, then you can then get that loan.
Mm-hmm.
So,
but you're buying this with
with the resi equity that we took out. So we've taken out that equity already, and we're just using that asset to then buy the commercial.
But is the deal still sticking up with the unrenovated property on the lease stock?
So that one we actually ended up buying completely unencumbered, because at that point in time it wouldn't have worked.
Wow.
So we took out this whole chunk of equity, bought that cash unencumbered from the equity, relied on the renovation to make it work. Why that one also kind of worked in our favor, because you couldn't get a bank loan for it. The value will go through and it's like, it's not habitable.
Yeah, okay.
So that was really the only way to make it work.
So 5 Dock was uninhabitable?
5 Dock was habitable. So
Okay.
5 Dock off the bat, we got a 65% land on that.
Oh, that's the one I was talking about. You're talking about Belmore.
Correct, yes.
Okay.
Yeah.
So Belmore was cash or 5 Dock was cash?
Belmore was cash.
Oh, okay.
Yeah, Belmore was cash through the equity,
Yeah.
did the renovation, then ended up stripping out the equity, and all of that equity ended up going to completing 5 Dock.
Wow.
Yeah.
And is 5 Dock a renovator or
It ended up being a renovator.
same thing?
Same thing. So bought it with, like in hindsight, we probably could have got away with not renovating it, but we had such a good uplift from Belmore. We were like, look, let's renovate the whole complex.
And what are you renovating? What are your costs? What's your sort of breakdown per unit? What are you doing?
For 5 Dock, it was pretty much everything, like gutted out the whole interior, new bathroom, new kitchen, flooring, paint, everything. Ended up being around 55,000 per unit.
Okay.
Yeah.
So you're buying that, let me crunch some numbers live on air.
Yep.
So you bought it for 6.5?
6.07.
607?
Yep.
Okay, and you're doing 50 grand a unit?
Yep. So there's 9. So let's say about 450.
Yep. So you're all in at 6.5?
Yep.
What does your reval come back at?
It was a little bit over 8 mil.
For that to work in that trust structure, for that initial purchase of it, obviously it's projected off the current rents. Is that then, once you get that current rent, it's a lease stock loan, right? So it doesn't even need to, does this trust still need to be self-sustaining in terms of loan and repayments?
Well, it will be self-sustaining in that instance, yeah.
But because it's lease stock, you don't have to worry about that with the
Yeah,
bank?
so it's all funded through the rent.
Wow.
Yeah, so none of your own gets tied into it. So that's also another benefit of lease stock, and they're all just in its own trusts.
Yeah, we'll get into a couple of the little tips, tricks, and secrets a little bit after. And then is Bondi Junction your latest?
I've got Auburn after that.
Okay. Yeah. Well, Bondi Junction is on paper your biggest purchase.
Yep.
That's huge.
So that was a block of 12 in Bondi, 10.85.
Same deal. You're crunching the numbers. You're saying 50, like you're putting 55 on it, and you're saying, I reckon I can get.
Yeah. So when it came to that, so with 5 Dock, we pretty much renovated the whole unit. Mm-hmm. But from the time that we settled on the project to when it actually got everything leased out, it was like almost 8 months.
Wow.
Yeah, it was just a long time between everything, and just the holding costs, the vacancy, that just ate into it a lot. So with Bondi, we took a slightly different approach. When a unit became vacant, we either renovated it, but firstly we tried to lease it out. There were some units that were in such bad shape that we had no choice. We had to renovate it. But the ones that we could lease out, we would then just lease out.
So you bought it already occupied with.
Correct, yeah. So they were all, yeah.
Any stories from the owner from that purchase or that auction?
It was also a deceased estate. So the matriarch of the family passed away, and the property went on to their children, who then decided to sell that property.
And cash out. Are you buying an auction too?
Correct, auction.
Wow, man. Hates an off market, huh? This guy pays the premium on the auction day bloody to get these things. But I guess that's what they do. And then, so that's Bondi Junction's more of a slow burn. That's going to be, that's 12?
12, correct.
12, yes. And that's just going to be once someone moves out, assess the unit.
Yes. Yeah. Because if it wasn't for that and you had 12 people vacant, you renovated it, just the cash flow on it would destroy you.
Yeah, true.
Yeah.
And is that the same trust structure?
Trust structure, correct, yeah.
What, 35% into that deal?
That one, luckily, we actually ended up getting 80% LVR on that because it was strata titled.
And they were worth more?
Not that it was worth more, but because they were individually strated,
Yeah.
we ended up getting it at 80% then for that one.
That's not bad.
Yeah. But it was high on rates on that one. So that one, in terms of rates, it was over 8%.
Okay.
Which I guess is the cost of doing business.
Cost of doing business, and you've got the opportunity, I'm sure you know the numbers, to get in there, reval, go again.
Yeah.
And then Auburn's sort of the last one, the latest purchase.
Correct, yeah.
What's that?
So that was a block of 7.
Yep.
2.93.
Yep.
So it was a little bit over 400 a pop.
Renovating as well?
Oh, it will be exactly the same as Bondi. I think after going through that process, we probably wouldn't renovate the whole complex in one go. We'll do it.
What about like a delayed settlement and getting early access or something?
Well, that one actually settles next month. So,
wow, okay.
So that's been already 5 months. So a lot of these will push out the settlement. And in that time, we're trying to finish up other projects, move money around just so then we can complete it.
To get into there.
Yep.
So a lot of these you're buying and not knowing how you're settling?
Yeah, a lot of the times, yeah. So I probably wouldn't advise it, no.
Okay. What's some wisdom and some advice that you can share from this experience that people can take into consideration when they're in their investing journeys? Keeping in mind, not everyone's at 80 plus properties, but in the early days and yeah, when you were first starting to sort of build.
Sure. I'll say one of the common questions that I get asked is like, and I've even said it myself in terms of focus on the end goal and having the end goal in mind. But what I've also come to realize is as you're trying to achieve that end goal, to then trying to break down the sequence in terms of how to get there. I'll kind of tell you an analogy around this, which will make a bit more sense. I forget the Olympian, but they interviewed this Olympian in terms of after they had won the gold medal, and they were like, what were you thinking of in the last 4 years? And the commentator was expecting the Olympian to say, me picturing myself on the podium with a gold medal draped around my neck. That was what everyone was expecting. And the Olympian goes, for the last 4 years, all I thought about was in terms of the process, how I would jump out of the blocks, my feet positioning. Then after that, as I'm going around the bend, my arm positioning, and I'm going down the home straight, what my legs, how my breathing was, and so on and so forth. So the key context of that is if you can focus on the process, the result will take care of itself. And why I think, and just with a lot of conversation with investors, is sometimes they're in this position, say for instance, they're at work and they just really want to quit work. All they think about is, I want to be quitting work, I want to have this passive income, but they're sitting on property too, and that might be a couple of years away. And just having that as the end goal may be daunting because it just feels like such a big stretch from there. But if you then say, for instance, chunk that down, instead of then purely focusing on that end result, just for the immediate, you're on property 2, focus on property 3. Where am I going to buy the third property? Where am I going to be looking in? For this particular day, have I spoken to a buyer's agent? Have I spoken to a broker? Have I spoken to the real estate agent? Have you done research on that suburb? By doing that and then breaking it down, it might not feel like a lot of progress, but if you do that consistently every single day and you do it for the next 2 to 3 years, I guarantee you the results at the end of that 3 years will be far beyond what you expect if you then didn't kind of chunk that down. It's that saying, it's people underestimate what can be achieved in the long term, but overestimate what can be achieved in the short term.
I love it. Yeah, that's true. It's like that 1% better every day, which doesn't sound like a lot, but when you zoom out over the year or the 2 years.
Correct.
Okay, so break down that investment journey and that end goal into just small chunks and worry about the next step, then the next step, then the next step.
100%. And I see it like in terms of broking because a client will come along and we'll, do the mud map, do the modeling. Then after that, they'll be like, can you model, say, the next 5 properties for me? And generally from a modeling basis, you can get the next one really accurate. But the next one after that it becomes a bit murkier because you don't know what the purchase price, the rent is then for the next one. The following one becomes even more murkier and so on and so forth. So instead of trying to then tell the future in terms of 4 or 5 properties later down the track, focus on the immediate that's within your control. You get that one ticked off, then the following one will become a little bit clearer and so on and so forth.
And we plug that into the modelling.
And then reshape it, and then you'll know more accurately. Also, at that point in time, the market might have changed. Interest rates might have changed. Rental returns might have changed. And I will say that's been exactly the same in terms of my journey, where when I was sitting on property 2, the only one that I could see kind of very, very clearly was property 3. 4 was a little bit murkier. If you asked me in 2013 what my 10th property would look like, absolutely no idea. But as you go down that journey, then it becomes clearer and clearer.
Yeah, that's some really good points. One thing I think you've done as well, exceptionally well, is you haven't followed the herd. You've almost went counter-cyclical. You've went against, mainstream media, which like you've seen it with interest rates, you've seen it with Perth. And we had an investor on a few weeks back who was selling a development project and, the Saturday was packed, the Sunday 60 Minutes aired the bricks and slaughter story I think it was in the 2010s, and like Monday, no offers, lost 800 grand on the resale of the deal. So it's like, if you can take yourself outside of what everyone else is doing and just, like you said, break it down, focus on it step by step, seems that like it becomes a lot more achievable and a lot more actionable. Because I can't imagine you're on property 2 thinking about unit blocks in Bondi Junction. You don't know.
100%. And even after we moved out of Perth, in terms of what our next step afterwards, absolutely unclear. If you'd spoken to me at that point in time, would have never known. But then once you get to that, and even after the first unit block, no idea how it would go.
What are some of your key lessons around that lending space into, what's holding a lot of people back from branching into that 6 to 10 properties and that next level? Like, is it a mindset thing, or like, how are you being able to build out your clients to get past, the typical investor that gets stuck at 3?
I would say the biggest one is in terms of interest rates and also cost.
Okay.
So what I mean by that is generally, like purely from a lending basis, structure-wise, if someone wants to build a larger property portfolio, you'll start off and use the harder to borrow from banks first. Like, let's call them your major banks. You'll use them first. Tend to be a little bit more conservative in terms of lending, but they'll give you a slightly better rate. After that, once you can't get lending from them, then you'll move down to another tier of lenders, a bit easier to borrow from, but a bit more of a premium, and then so on and so forth. But as you start to then take on more lending and you use banks that are even easier to borrow from, then their interest rates also go up. So say, for instance, in terms of the major banks, for investment interest only, just purely example, maybe 6.5, 6.6, and you can progressively go all the way down over 8% on your second, third tier, fourth tier lenders. They kind of creep up over time. And a lot of people can build and can borrow, but because they see, say, 7% in front of it or 8%, they choose not to. And this is purely personal. I'm not saying right or wrong, but I'm just saying that in terms of if you did want to grow your property portfolio and you looked at in terms of what the growth in certain markets have done, the amount of potential growth compared to the cost of paying that additional interest rate, it's inconsequential in the grand scheme of things. And it's like similar to that Bondi example. Do I want to be paying 8.2, 8.3% on the rates? No, absolutely not. I would much rather be paying the 6.5, 6.6. But for me, I made that conscious decision before the rates started going down, I guess this week, that I'll pay a little bit of a rate premium to get into the market. When the rate starts coming down, that unit block will not be for the same price anymore. And then when the rates start coming down, everyone's borrowing capacity improves. The prices will go up, but my borrowing capacity will also improve. Then I'll move that away from the lower tier lender back up to a major bank. So
it's like people don't understand. It's just that short term pain, because you might have to have it in that borrower for a year.
Yep.
If it's in your case, let's use your case example. If it's a $10 million purchase, you're paying 200 grand a year. That's 200 grand a year. Have I done that right? That math right? 200 grand a year. Yeah, 20 grand a year per million times it by 10. That's 200 grand a year difference in repayments. However, you've got a $10 million portfolio that's also...
So I'm banking on 200 grand across 12 units. So if each of the units went up more than 20,000, then I've done okay.
Yeah, exactly. And if you look at it in Bondi Junction, in Eastern Suburbs market.
Correct.
Yeah, and that's for 1 year as well. Then you can refinance and get out of that. I bought a development site the other day, and the only time that I saw the interest rate when I was signing the loan papers, because it didn't even come into consideration. It's who can get me this loan, who can lend me the most amount. Like for me personally, was who can get me this loan, who can get me into this deal. Because if it's 6 or 8%, I don't care. It's an extra 20. It's an extra 2% on interest rates, but it gets me into the deal to do the development that I know will pay me, so much more than whatever an extra 2% on interest rate is. So really good point to touch on, and I think people need to learn. I say it all the time. They hear it from you, a guy that's got 80 plus property portfolio. There's a bit of weight to it. Is there anything else in terms of, what about structuring?
Structuring? This is probably the most common question that I get asked in terms of using trust to purchase properties. And I think in the ideal case scenario, trust can work, but to actually pull it off for an investor that's starting out is very difficult. And the part that's the hardest is getting the accountant to write you the letter to say that the trust is self-sufficient. My question to a lot of investors is, at the moment when the rates are, say, 6, 6.5, where can you buy in Australia from day one that's going to be positive? That's already the interest rate. Then you hold on all the holding costs on top of that. I don't know that many areas that are decent buying for 7 or 8% rental return.
Yeah, well, it just means you've got to put in a larger deposit, right, for it to work in the trust. Then you've got to go into, 25, 30% plus.
But the problem with that then is that slows you down.
Because you put all your capital into it.
Yeah, correct. So, and then there's other heaps of considerations around. So I'll, kind of explain the negatives of trust too, and then you can offset that with the positives. So, the negatives of the trust, everyone knows the accounting fees, running it and so on and so forth. I pay my accountant a lot of money. I've got too many trusts, but, that was the reason for the setup, but it definitely costs a pretty penny. The second one is if there is negative gearing benefits, it doesn't flow back to you. It gets contained in the trust. I know early on when a lot of my properties were in my personal name and I was at corporate, when I did my tax return, when you factored in all the depreciation and everything, I was getting like a $20,000 tax return. And early on, as someone with not a lot of money, that was a huge difference.
Payday, baby.
Correct.
Yeah. You didn't do a quarterly?
No, I didn't. But, that was pretty much the funds for a renovation there. So that would make a huge difference early on. And the other big consideration is around land tax. So say, for instance, if you buy in New South Wales, you buy it under your own name, you get over $1 million worth of land tax threshold. You buy in a trust, land tax from day one. And if people looked at the land tax thresholds between a trust and then also in their personal name, in Queensland, it's heaps higher in a trust.
Yep.
And then also in Victoria, it's heaps higher in a trust again. So, and when I was first starting out, my question to accountants when I was interviewing them was, should I buy in my own name or should I buy in my personal name? And he pretty much said, use all the land tax threshold that you have in your own personal name, then consider trusts. So pretty much what I did, say for instance, in Queensland, because I was buying a lot there, was use the 600,000 threshold in my name, use the 600,000 in my missus, so soak up the 1.2, set up a trust. The trust will come with 350 threshold. Use that up, set up another trust, use that up, and then keep going. I've got about 7 trusts now in Queensland, and at least then you get that land tax benefit from it.
Yep. But, it's almost offset with the trust costs, the ongoing costs, right?
Correct.
Correct. It's
correct.
Not the same
it
price. It
kind of balances out. But if you've got land tax threshold in your own name first, you're giving up that freebie in your name, moving it into the trust, no negative gearing, contained in the trust, you've got the high accounting fees, and then if your land value is over 350, say for instance in Queensland, you're going to be then paying a mozza. And why I came to that conclusion too was early on when I first started, I was listening to a lot of, back then there wasn't podcasts, but reading on forums, going to seminars, and there was a couple of seminars going around, which was pretty much buy in a trust. Trust is the best thing since sliced bread. And my parents were investing at the time and they were buying in Sydney. And they were buying an investment property in Rooty Hill. And I'm like, Mum, Dad, buy under a trust. This is the best thing. Like all the rich families buy in a trust. So they bought this house in Rooty Hill. Yeah. At the end of the year, they got a $5,000 land tax bill. And they were like, Michael, what's this? And I'm like, got no idea. So ever since they bought that property, every year they pay that land tax bill, or actually now I pay it, but they pay that land tax bill.
No, you pay it.
Two, the negative gearing was contained in the trust.
Yeah.
So the cash flow was worse. And it was in Sydney and Rudy Hill, so it's negative. They weren't going to get their counter letter, so it didn't help from a lending basis. So just off the bat, when you looked at all the negatives, it was more than $10,000 extra holding costs just to put it in a trust with no benefit. So that's why it's not like I am here, other people going, oh, automatically just buy under a trust. Like there are so many considerations around it. So in terms of the unit blocks I buy, absolutely, I buy them under a trust, easier to get the lending for the lease stocks and so on and so forth. But, you know, I'm also keeping one eye on Melbourne at the moment, you know, kind of going counter market.
You're a bit late on Melbourne, man.
Yeah.
People have got in at Melbourne already.
Well, that's because all the funds were tied up in Sydney.
Yeah.
But like I think very good things about Melbourne. I don't have any land tax threshold in Melbourne. Like I know it's only 50,000, but hopefully in 9 years' time it goes back up to the 300. But my first property, I'll put 50,000 in my name. Second one, I'll put in my missus' name. At least I can soak up a little bit of the land tax threshold.
Yeah, okay. It's not going to be much though, right?
No, it won't be much. But you know, if you put that same property in your own name, I think for a land value around 500,000 in your own name, the land tax is probably about 1,700, 1,800. In a trust, it's close to double that, like 3,500. Yeah,
it's you got to consider everything, right? It's the cost of doing business, but it's also like, yeah, you're going to pay, you know, 1,700 in a holding cost to buy in Victoria, but you know, if you're going in Queensland, and depends if it's tropical or not, you'll pay more in insurance.
Correct, exactly. And then the other thing with like Victoria too is how's that property going to be positive? You know, with the rental return there, like you might be another cycle before it's positive. So you're not going to get that accounting letter anyway. And then purely from a lending basis, there's other things, you know, the interest rates for properties held in a trust tends to be a bit higher, additional package fees. And there's one big one where so generally when you go for a loan, the banks add on 3% to your assessment rate to see whether you can afford the mortgage or not. But if the loan's been around for 12 months, instead of adding on 3%, some banks only add on 1%. So you could then use these banks that are easier to borrow from. After 12 months, move them all back up to a bigger bank because the assessment rate's only 1%. That policy only applies when it's in your personal name, doesn't apply in trusts. So when you sometimes have to dabble with these trusts with the lower tier lenders, you're pretty much just stuck there.
Yeah, wow.
Yeah. So like I'm not saying no to trust. I'm just saying that it's not as clear cut to say, oh, trust will add more to your borrowing capacity. There's so many other layers of conversation around it.
Definitely. And I think a lot of people that are saying to do it are theorists rather than practitioners in that space, and have educated themselves a little bit maybe at the seminars or whatever. But like, did they actually have property in trust? Do they know how it works? Do they know the implications? I don't know. Questions to ask them. But a lot of the time people say, oh, you can just buy it in trust and keep buying forever. But it's like, whoa. Let's slow this down a little bit and understand the full ramifications. So out of your portfolio, you've said that your unit blocks and stuff, which is probably, I don't know, half of it, is obviously trusts because of the lending side of it. But in terms of the single properties, you know, you've got a couple of units, you've got a couple of houses, you've got Perth, you've got New South Wales, you've got Queensland.
Yep.
What portion of that is probably your own name versus trusts?
Exact percentage, I'm not 100% sure, but I can
probably
say...
the only thing you didn't put in this spreadsheet.
So I would say that in terms of the ones I've got in the trust will be the unit blocks, the ones that are slated for development in Brisbane. There's a couple here or there in Brisbane that are in the trust to soak up the 350 threshold when we had set that up. But then the vast majority of everything else is in personal names. But initially, early on, a lot of it was in personal names to then soak up the land tax threshold.
So land tax threshold, and obviously, lending is a game of income and finance. So you're just pushing yourself. Are you lending? Are you paying yourself out of your mortgage broking business like a large salary, or is it just because you're obviously a director of that business, you're able to get the loan?
Yeah, correct. So with the banks, they'll count the salary that you pay yourself and also the net profit before tax. Mm-hmm. So because I'm the sole director, it doesn't matter whether it's salary or net profit, they'll just roll it up and count it.
Does it have the same multiple in terms of like, you know, people say your income comes out, your income is post-tax,
Like
multiple
6 or 7%.
yeah, maybe it's a bit lower. Is it similar with company lending, or is it case by case?
Yeah, more so case by case, because there's so many other factors in terms of your rent on all the properties. So pretty much for the lending, everything will get washed up.
Yeah.
So your net profit in the business, what you pay yourself, and all the properties, rental returns.
How's
all the
tax
loans.
time?
Not fun. Like, it is. And
What's your relationship with your accountant?
actually, I was in a meeting with them.
Does he hate you? Or what?
Yeah, he actually does. So IMUs, and it's a shout out to Nick at Strategic Wealth. I've been with them ever since I had 2 properties.
Wow.
So from 2 all the way up.
Nick who?
Nick Mustakis at Strategic Wealth Management. They run a phenomenal operation there. And afterwards, I found out that my mentor, Rolf, uses them too. That was like after the fact, like completely unrelated.
Strategic Wealth
Management in Hurstville, in Sydney. Yeah. And so kind of backstory to when I was interviewing for accountants, and like I asked them, should I buy in a trust or should I buy in my own name? Mm-hmm. And back then, Nick gave me the answer of, look, don't set up trust. You don't need to go down that path. Buy in your own name, soak up the land tax, and then we'll talk about it. Early on, keep it simple. And some accountants that I interviewed back then were like, yeah, trust is the best thing. 1 property, 1 trust. Looking back, I think they just wanted to make a lot of admin money from me.
That's very true. Well, look, the way Michael, it's been honestly amazing to Nick Mustakis expect a call from the Everything Property team, but it's been really eye-opening. I think what's refreshing is that you've went sort of counter-cyclical, you've done your own thing, you haven't followed the herd, you've broke it down into individual steps, and you've also, as you've grown in your business and in your portfolio, you've been able to successfully move up in terms of different strategies and different ways to do things. So I've found that refreshing, and there's a lot of takeaways. The way we typically end, I ask for 1 bit of advice that you can give. So it can be, your younger self. It could be someone wanting to build a portfolio like yours or anything. And then I also ask for a quote you live your life by. So I ask you the first one. What's that bit of advice that you want to share with the audience that they can take away, they can either implement today, or, it's someone it's younger you or someone that's building to something similar?
Sure. So I would say in terms of key takeaway, something that I realized after buying that first property, which was off the plan, is generally in life, if you want to make money, solve problems. So if you look at, all the people that say Elon Musk, the number of problems that he's solving in terms of humanity. And the same applies to when it comes to properties. If you can solve problems when it comes to properties, then you will then do well from it. And I'll break down kind of in terms of properties into 2 kind of types of problem in properties. There's one which is money can solve problems. So I'll give you an example of that. You walk inside a property, bad carpet, the paint's mismatching, kitchen run down, bathroom shoddy. Those types of money can solve problems I love. Those are the things that I target. You fix that problem and then you stand to gain from the property. There's other problems when it comes to properties, which is money can't solve problems. It's in a flood zone, next to a highway, next to the cemetery. No matter how much money you put into that property, that problem will still be there. I tend to shy away from those problems. So in terms of your listeners, if they're looking to do well in property, don't be like me and buy off the plan, because you're not solving any problems. The developer and also the builder solve that problem for you, but look for money can solve problems.
That's a mad tip. I like that one.
Yeah.
I haven't heard that before.
Yeah,
that's a good way to put it too.
Yeah, and a lot of people look at a property and they're like, should I buy it or should I not buy it? And I'll explain that to them. I'm like, is the problem that you're associating with it, is it a money can solve or money can't solve problem?
Mad.
Yeah.
Charles is shaking his head too. That's crazy. All right, now tell me as well, Michael, what is a quote you live your life by?
The one thing kind of struck by me was in terms of it's simple but not easy. So I find in terms of overall property investing, it's fairly simple. I find too many people try to overcomplicate it. You pretty much just, buy when everyone else is scared. You buy something, decent location, decent rent, and just hold it for the long term. But is it easy? Like overall, not that easy. Like especially when you want to kind of, continue to grow it, you're always going to hit headaches. But if you can have that focus and be consistent over a long period of time, then you'll do well from it. So simple, but not easy.
Cracker. Michael Shah, I appreciate you joining us on the Everything Property podcast. And, mate, we'll put your contact details in the show notes for anyone that's wanting to ramp up and hit that, follow you on your journey and hit the 80 property portfolio. I appreciate you coming on.